If you think the biggest risk to your money in 2026 is a market crash, you're looking in the wrong place. The real danger isn't losing money fast, it's losing time slowly and quietly until one day you realize the plan failed and there's no runway left to fix it. Most people won't lose everything in a dramatic collapse. They'll lose 3 years, 5 years, a delayed retirement, a forced return to work when they thought they were done. And the reason won't be bad luck. It will be a risk they never knew they were taking. There's a moment in financial history almost nobody talks about anymore, even though it explains nearly every market disaster we keep repeating. In the early 1700s, France was drowning in debt after decades of war. Gold was scarce, taxes were high, the economy barely functioned, trust in the system was thin, and the system itself had no room left to maneuver. Then a charismatic outsider arrived with what sounded like a miracle. His idea was simple, almost elegant. Money didn't have to be limited by gold. It could be backed by future growth, by belief, by confidence. The government loved it. Desperate systems always do. Paper money was printed, shares were issued in a company that supposedly controlled vast, fertile lands overseas. Prices rose, people felt rich. Crowds formed in the streets just to buy more shares. Ordinary families sold homes, jewelry, businesses, anything liquid to get in. And for a while it worked, until reality showed up. The land produced nothing, the profits never came. When people tried to convert their paper wealth into something real, the system couldn't deliver, confidence vanished, prices collapsed, families were wiped out, and the economy froze for decades. What matters is not the name of the scheme. What matters is the pattern, because that pattern never disappeared. It just learned to dress better. Today, the scheme doesn't look like a man in a powdered wig running a national bank. It looks like your retirement account, your index fund, your safe long-term investment plan, and the most dangerous part is that almost nobody realizes what bet they're actually making. If you've ever felt that investing advice sounds clean and logical in theory, but somehow fails when real life hits, when inflation rises, markets drop, or timing suddenly matters, you're not broken. You're reacting normally to a system that hides risk behind comforting language. Words like diversification, long-term, buy and hold, and set it and forget it feel reassuring. They reduce anxiety. They give people permission to stop thinking. But psychology tells us something uncomfortable. Humans are terrible at detecting slow, invisible risk, especially when authority figures tell us everything is fine. And right now, the biggest risk in markets isn't volatility, it's concentration. As we enter 2026, more than 30% of the total value of the S&P 500 sits in just 7 companies, 7 out of 500. That's not diversification in any meaningful sense. That's a heavily concentrated bet wearing a diversified costume. Historically, this level of concentration is rare. In the 1990s, the largest companies made up roughly half of that share. Even during previous bubbles, leadership was more spread out. Today, a single stock dropping sharply can meaningfully move what's supposed to be the safest index in the world. This matters because of how index funds are built. Market cap weighting automatically pushes more money into whatever has already gone up the most. It doesn't ask whether prices make sense. It doesn't assess value. It simply follows momentum. That's not discipline. That's autopilot. If this feels unprecedented, it isn't. In the early 1970s, institutional investors became obsessed with a group of perfect companies known as the Nifty 50. These were dominant, profitable, essential American businesses. The belief was simple. These companies were so strong that price didn't matter. Valuations exploded. Some traded at price-to-earnings ratios above 60 or even 80. Investors justified it by saying growth would eventually catch up. Then inflation hit, oil prices spiked, economic conditions changed. What followed wasn't a gentle correction. It was devastation. Some of the safest companies in America lost 70, 80, even 90% of their value. Many never recovered in real terms for decades. And the lesson wasn't that those companies were bad. The lesson was that paying too much for certainty is the most dangerous risk of all. Academic research on valuation cycles shows this pattern repeatedly. High concentration combined with high valuations dramatically increases downside risk, even when businesses themselves are excellent. Here's the part that makes people uncomfortable. Most investors aren't wrong about what they own. They're wrong about when the risk shows up. Risk doesn't announce itself when everything is going up. It shows up late when time matters most. That's why people don't panic at 35. They panic at 58, not because markets fall, but because markets fall when they can't wait anymore. The hardest conversations I've had weren't about losing money. They were about realizing the plan failed when there was no time left to fix it. People who did everything right, saved consistently, avoided debt, followed the rules, and still ended up cornered by timing. That moment changes how you see risk forever. Imagine a middle-class couple with two incomes and no wild spending. They invest through workplace retirement accounts, mostly in broad index funds, and plan to retire at 62. Then a major market downturn hits at 59. Their portfolio drops around 25 to 30%. Suddenly the math doesn't work anymore. They don't panic immediately, but they don't have the luxury of waiting either. They delay retirement by 3 to 5 years, not because they were irresponsible, but because their portfolio was fragile at exactly the wrong time. Same market, same index, different outcome than expected. So what would I actually do starting in 2026? Not what sounds good, not what worked in 2010, not what's easiest, but what actually matches the environment we're in now. First, audit reality, not assumptions. Look at your top holdings. Add the percentages. If the top 10 exceed roughly a quarter of your portfolio, you're concentrated. Most people have never done this. And that alone is a wake-up call. Second, invert the concentration. Instead of letting the system automatically overweight what's already expensive, deliberately allocate to areas that are less correlated and less inflated, equal weight strategies. International markets and value-tilted segments don't outperform every year, but they tend to fail differently and at different times. And that matters more than bragging rights. Third, install rules that override emotion. Emotion is expensive. Rules are cheap. Rebalancing based on size or valuation isn't market timing. It's risk management. Endowments and long-horizon funds do this quietly, while retail investors are told not to, because passive money is easier to manage than thoughtful money. Fourth, build a non-market income floor. This is psychological armor. People don't panic because markets fall. They panic because they need the money while markets fall. Cash buffers and alternative income streams prevent forced selling. During every major crash, investors with liquidity survived better. Not because they were smarter, but because they had options. Same crash, different outcome. Fifth, be honest about time. Sequence risk is real. Losing 25% at 30 is inconvenient. Losing 25% at 55 can be life-altering. If you're within a decade of needing capital, you cannot afford to gamble on perfection. Continuing indefinitely, lower returns with survivability beat higher returns with fragility. This leads to a clear personal direction for 2026. Do not chase outperform because outperformance is seductive, but increases fragility. Do not all in on narratives because narratives feel safe, right until they don't. Optimize the sleep at night factor because if your portfolio keeps you anxious, it's already too risky. And a portfolio that lets you stay calm through volatility will outperform in real life, even if it underperforms on paper during hype cycles. None of this is exciting. There's no leverage, no secret strategy, no guaranteed upside, just structural awareness, behavioral discipline, and humility about uncertainty. And that's exactly why it works. Wealth that survives multiple environments isn't built by chasing extremes. It's built by avoiding irreversible mistakes. The financial industry thrives on complexity because complexity discourages questions. Simplicity with awareness threatens that model. You don't need to predict crashes. You need to avoid being overexposed when they happen. That requires a final shift in how you think. Stop treating your portfolio like a houseplant, watering it, and ignoring it worked during decades of falling interest rates and expanding valuations. But those tailwinds are gone. Now you have to treat it like a garden. You still plant and water, but you also prune, rotate, and adapt to seasons. Not daily trading, not obsession, but engagement. Because when the next downturn arrives, and it will, you'll either feel helpless or prepared. Prepared people don't panic, they adapt. And adaptation is where long-term wealth actually comes from. The real lesson of 2026 is simple. Markets don't destroy wealth. Fragility does. The danger isn't investing. It's assuming the default option is still neutral when conditions have changed. You don't need to abandon stocks or predict the future. You just need to understand the bet you're making. and decide whether it still makes sense, because 2026 is not about getting rich. It's about not getting fragile. This isn't for people chasing excitement. This is for people who don't want to be forced back to work at 65. So tonight, don't watch another video or chase another strategy. Open your portfolio, look at the concentration, because that single step alone puts you ahead of most people. And that's how real wealth starts. Quietly, deliberately, before everyone else realizes something has shifted. Thanks for watching.